Welcome back. Now, as increased tariffs rock the world in Africa, the silver lining is that it could give impetus to spurring on the African Continental Free Trade Area. But of the many challenges to getting it off the ground is the high cost of capital, as sovereigns cannot invest in the infrastructure needed to facilitate trade if they are servicing debt at unmanageable levels. Bronwyn Seaborn caught up with Luthando Vuba, Executive Head of International Trade in the Business and Commercial Banking Division of Standard Bank, at an event the lender hosted about financing Africa forward, and asked him how the high cost of capital is weighing on the development of the African Continental Free Trade Area.
I think you really struck the ideal connection between what we're seeing happening with geopolitics and the tariffs, and also how that then translates to this topic of cost of capital. So I want to start with the tariffs first. With the tariffs, the tariffs are not a new thing. However, we have to admit that in this year it's become very topical. The biggest thing that's a concern around the tariffs is the impact it has to some specific value chains that have been concentrated in supplying into the US in particular. Less so the tariffs, but then the removal of AGOA, because what the tariffs, the announcements have done, they've sort of superseded that. So you have impact to textile and auto value chains. But then when we're trying to think about those value chains and those businesses that are supplying into those manufacturers and the manufacturers themselves, and we're looking at alternative market access, and we talk the African Continental Free Trade Area, even in the regional economic communities, we're talking about the immediate opportunities there, certainly, and the free trade area allows for it to be, even more incentivized to consider it. However, the infrastructure that's required to really make it easy and cost effective is not in place. We have a concentration of 80% of goods on the continent moved by road. That is considerably more, probably your most expensive option to move goods. Rail is probably your most optimal. We have air and we have maritime. So if we look at where those are and how optimal they are for movement of goods, it's really the impediment on why we are not seeing more intra-Africa trade, and currently sitting around 14 to 15% of Africa's trade when you compare it globally. So the cost of capital is a key then inhibitor in what currently African markets experience. OECD countries on average from their budget account for around 6% of their debt servicing. African markets, that is between 17% and 50% of their budgets. So when we have to think about what African governments are looking at is, one, they do not want to default because of the impact that the impact that would further have on the sovereign and wherever the risk grade is. So you're having them having to weigh up against priorities then of servicing the debt and what remains, then looking at the other priorities, and then furthermore, when we look at then those risk grades that are applied to African sovereigns, our research indicates that on average there's about 4 rungs lower than what they should be pegged at, and that directly impacts the premium, the risk premium that they have to pay that debt at. And remember, they're servicing this debt in foreign currency. So it is also impacting forex reserves that we need for import. So when we're talking about developing the roads or the infrastructure for railway, or just our manufacturing capacity, there's quite a bit that needs to be imported to industrialize, and that also directly impacts the African sovereign's ability to then pay for import. So practically, when you outlay, that's how all of this ties back to the cost of capital topic. And I think that's one aspect that's really directly impacting on that. However, through this process, there's quite a number of good ideas that is looking to how do we address that, how do we look at alternative ways of financing, right? From private capital, pension funds, better role played by DFIs and your multilateral development banks when it comes to risk and playing within the mandate of taking the risk on that value chain of those projects, better preparation of investable projects, making sure they are investable. We have around 90% failure rate of projects just at pre-planning stages. So Those are some of the practical elements. In addition to that, we have in South Africa, but broadly for the continent, it will be good to be institutionalized. The public-private partnership in South Africa, we have a policy around it. If that would be institutionalized and create room for the participation of philanthropic capital, and really looking at blended finance and this, what we have come to call now not the triple P, but the quadruple P, that includes philanthropic capital being sort of alternative mechanisms that can help with financing infrastructure. And I really see those being some of the mechanisms that can help us deal this issue. But importantly, we need a review on just how the sovereigns are rated from a risk rate.
It's a complex problem. It almost seems too big to even start addressing, because there are so many moving parts. I know we speak almost at this level of Africa being this homogenous kind of area, and that's not it either. You highlight some of the solutions there in terms of what can be done to get the infrastructure up and running while we still have this problem of the high cost of capital. My sense of it all is that because it's such a problem, there needs to be some urgency. Do you feel that we are obsessed with this idea of making the infrastructure, work for us, accessing some of the solutions that you've put forward there as Africa, so that we do have the infrastructure investment we need? And I say obsessed because in that, it must mean that there is urgency, that we have to get this done. Are you reading it as that? Because sometimes on these things, it just feels like the cogs move too slowly.
Yeah, no. Bronwyn, is a difficult one to really answer. But I think if we look at just where and how much is being allocated to infrastructure in sovereign budgets, for me, it points to that it's not urgent enough. It is competing with other interests. We've seen how that can even affect sort of the civil part of the country and what was happening in Kenya, because of how much that they had to pay away in servicing debt in the fiscus. So and to contextualize the problem, Africa needs around $170 billion annually for infrastructure spends to be where they need to be. We currently have around 85 billion going towards that, so half of it is missing. So we need another $85 billion, and to contextualize it in real numbers, that's around 1.5 trillion rands. That's just under a quarter of South Africa's economy. South Africa's economy is the number one economy, was the biggest economy on the continent. So when you package it like that just under a quarter of the biggest economy on the continent is the gap in infrastructure spend, and then to your point or your question around urgency, I'll just use the numbers to answer that. And what we need is a revisit to that, but also need a revisit that is aligned. And I think a greater role played by the likes of the AU to make this a priority, to make this the focus area, that we really see that the prosperity of Africa is tied into investing in its own infrastructure. And it should be not exclusive, but inclusive of the critical sectors that we need to win in, healthcare, or health, energy. Because we can talk about industry, we can talk about manufacturing and infrastructure. If we don't have the energy to power those, So I think those are critical. And a very important point has been made this morning around, for Africa's development, we will have to look at our minerals and therefore fossil fuels. And to contextualize that, we are a continent that's contributing only 4% of carbon emissions. So when it comes to topics such as just energy transition, I think those need to be balanced with where we need to get to for Africa's development, whilst balancing the degree to which the continent would be contributing to the carbon emissions. So I think when you talk about the topic of infrastructure, when we really contextualize in real numbers, it sounds big, but when we bring it close to what are the critical things that's required in each sovereign, and how do we redirect spend, and how do we open up, how do we tell the story better as African sovereigns to be investable, and how do we invest in the technical capacity to really package and plan projects that they're investable. I think we'll see a lower default rate of projects. We'll see greater interest to invest in Africa. And when it comes to returns, the story tells itself. Data, coming out of the World Bank, suggests that around 6 times more than S&P is the returns from, from investing in the continent. So, again, you don't read that everywhere, but you read that, it's risky to invest in Africa. Africa is risky, and I think so. When it comes to it, I think it's very important that we tell a better story of Africa. From this morning's conversation, was highlighted that just negative stories alone cost Africa around $4.5 billion a year. So I think that's an important one. It's an important one, particularly for our emerging markets on the continent. How do we tell the story better, use data to really show that it's investable, the returns are good, and we actually have very, very low default rates. I think that's what I think about the urgency of it, and that's what we can do to move things forward.
That was Luthando Vuba, Executive Head of International Trade in the Business and Commercial Banking Division of Standard Bank.